A lot of what we're hearing in this early roadshow stages is from the fallout from the Lyft IPO, which was about a month ago now. The Lyft IPO did price in the high end of the range, but it has seen performance plummet since it went public, about more than 25% down lower since it IPO'd. So some investors are a little bit more cautious about these ride-hailing companies now that we have the first one that's gone public. Now, Uber is, of course, a lot bigger than Lyft, and that is important to look at when we're looking at these numbers. Shares are expected to price between $44 and $50, and with this market cap, like you mentioned, between $80 to $90 billion. This is an IPO worth about $9 billion, so it would be the second biggest tech IPO in U.S. markets in recent history. So it still is a different company. It has a bigger international presence. It isn't exactly Lyft, but there is a little bit of hesitation, and we know why some of that hesitation is, and it comes down to the losses. So in this S1 filing last quarter from the SEC, we saw that Uber had a loss of $1 billion now, even though it had revenues of $3 billion. So the question is still remaining there.
I mean, I'm almost given up in my job on certain valuations of certain companies. I'll still rant about other things. It's like last week, Delivery Hero. All I could see was, oh my gosh, 93% increase in first quarter revenue. Wow, amazing. And nobody bothered mentioning that the fact that their adjusted EBIT are a disaster. Their losses expected for this year are horrendous. No one cares. Everyone's just looking at the orders. So my question is to you, is there any point in worrying about the losses? Because investors will buy into this stuff anyway.
The only reason you would want to worry is by looking at the performance of the only comparable point that we have, which is Lyft, and the shares have tumbled for Lyft. So there maybe are some people out there, and maybe it takes until these companies go public for them to really show that concern. But you're right. There is certainly a lot of focus on this company's growth and focus on how it's entered not just the ride-hailing market. A lot of that S1 filing, which is the filing that shows that Uber is going public, was focused on Uber Eats, which is this other part of Uber's business that's been actually, more of a moneymaker than maybe the ride-hailing company might be, and that's something that Uber is certainly trying to emphasize in its public.
Well, the share of the revenue from
you said more of a moneymaker,
but still not
making money. You mean less
money.
losses than the other?
Exactly.
Let's be correct about this, because I think it's actually important. Less losses than the core part of its business, rather than making money.
But the revenue coming from that's also been declining. So the share of revenue coming from Eats fell from 13.3% at the end of 2017 to 6.4% in the fourth quarter. And this is one of the issues that I have with the stock, the upcoming stock, is that it's not growing as fast as it was growing. So if you're looking at one of those opportunities, a new company coming to market, you're in it for the growth story. We know how slowing growth goes. We've seen it in other companies. Facebook over time, when investors have been questioning the path, whether it can continue with subscribers. So are we at that point already around Uber before we even see it come to market?
It's a great point, given that what Uber waited to do for so long was to go public. I mean, what the whole story out of many of these Silicon Valley companies, Uber included, is that they stayed in the private markets for much longer than a company growing at that size normally would have. And so as a result, it has this massive valuation, but maybe the growth is already starting to slow down by the time it's entering the public space. Uber says, we have lots of new markets we plan to expand into. We can continue to invest in scooter sharing, and there's other markets beyond just food delivery, but it's plenty of competition in other markets and in other spaces.
Can I just ask you about the voting structure? How would that be allocated after the IPO? Because that's one of the other challenging areas with these technology companies, that even though shares are listed, they seem to come with less rights than other ownership stakes. So what's the story with Uber?
We're seeing a growing number of these dual listed IPOs, and that is, in a way, it's been kind of, the founders have tried to say this isn't about us retaining more control, but in the end, that's sort of how it's played out. This, one of the examples of that was Facebook, which we've seen a little bit of how Zuckerberg, ultimately is owning that company, even though there's been calls to say we need to give him less control, and they can't, because he's both the chairman and the CEO and owns the majority. So I think this is an interesting move that we're making, and the owners of these companies do have so much kind of power, given that they've been in the private markets for so long. I mean, one point that's really interesting with Uber is Travis Kalanick, the kind of embattled CEO who was there for so long, has a 6.7% stake in this company. So he's going to make $5.3 billion on this IPO, and he's nowhere involved, well, as far as we know, nowhere involved in this company anymore.
Just about annual meetings, one of those fun features for investors turning up, right?
Exactly.
Hey, I want to ask you about self-driving cars because I was looking at some of the numbers, and obviously this would be a hugely disruptive feature if somebody else got going ahead of Uber and Uber was not in any form of collaboration, because the overhead costs of a driver, you'd have to say, might be impacted if someone else is putting a fleet out there with no drivers in it. The amount of money the company's been spending was $457 million on R&D last year, so this has been increasing. They've got $1 million set aside, which means in a couple of years they've got to come back to market and raise more money. So the same investors who are being asked to put money in now might be on the hook for more money down the track in 2 years.
And the investors really have to buy into this idea that Uber will be ultimately an auto company in addition to kind of this gig economy ride-hailing service company. And you could see in that filing with the SEC that Uber released on Friday how much of a focus freight and autonomous is, and it's really trying from the get-go to sell itself as an auto company, even though it has no real precedent there so far.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.